What if the biggest threat to the artificial intelligence boom isn't a shortage of electrical power or a regulatory delay? What if the entire multi-trillion-dollar AI infrastructure is fundamentally flawed and the smartest investors are quietly retreating? Check your information feeds now. Look at the headlines from the leading Wall Street supporters. The noise they want you to believe is nothing but false comfort. Venture capitalists and retail day traders are fixated on every drop in valuation, telling you, don't panic. This is just a healthy mid-cycle consolidation. The generative AI revolution is limitless. The demand from businesses is never-ending, and corporate capital spending will continue forever. They want to convince you that traditional economic rules do not apply to silicon wafers. But the signal, the hard data from deep within the global supply chain, reveals a serious structural issue. The global AI narrative is meeting serious obstacles, from high-level macroeconomic asset managers in Shanghai to legendary contrarian investors in the West. Data indicates that the AI superbubble is entering a risky and volatile phase. We aren't just seeing stretched equity multiples anymore. We're witnessing significant insider selling, slowing revenue at leading labs, a loop of capital that resembles systemic fraud, and the world's largest hardware consumer desperately searching for cheaper supply chains to alleviate the burden of high AI chip prices. My name is Newell. Welcome back to the Signal and Noise podcast. Take a moment to click like and subscribe to keep your capital grounded in reality. Today, we'll examine the structural weaknesses in the global AI ecosystem. We will look at the superbubble warnings from Asia, discuss the accounting assumptions that led the famous Michael Burry to buy substantial bearish options, and explain how Apple's backdoor supply chain tactics show that the hardware model has hit its limits. Let's dive in. Let's focus on the institutional investors in Asia. While retail investors in the West chase momentum, major macro funds in China are sounding the alarm. The 2007 precedent Wellspring Asset Management, a prominent fund, has told its investors that global AI stocks have formed a massive super bubble. To grasp the weight of that statement, consider the founder, Yang Dong, well respected for calling the peak of the Chinese stock market right before the 2007 financial crisis. His current warning is chilling. The collapse point may not be far away. Shanghai Banksia Investment Management has gone further. They warned investors that the specific trigger for the AI bubble to burst has already happened. Instead of blaming general market conditions, they pointed straight at Anthropic. The revenue wall. Banksia's data shows that annual recurring revenue growth among frontier model companies has slowed significantly. They predict that Anthropic's year-end revenue will drastically fall short of inflated market expectations. The asymmetric shift. Out of 11 major Chinese hedge funds tracked, at least 6 have completely shifted away from a positive view on AI. Wellspring is warning that some of the hottest AI infrastructure stocks lack solid competitive advantages, depend on ordinary business models, and could crash by over 80%. This suggests that the revenue from AI software isn't growing quickly enough to justify the upfront capital investment. The software companies are hitting a revenue ceiling, meaning the significant data center upgrades will soon run into barriers. This breakdown isn't just happening in Asia. The same pattern outside China reflects internal exhaustion. Let's examine the well-known Big Short investor, Michael Burry. SEC filings reveal that Burry's fund, Cyan Asset Management, has placed significant bearish put options against the stars of the AI boom, NVIDIA and Palantir Technologies, the picture of fraud thesis. Burry isn't shorting these companies because he believes the technology is misleading. He is shorting them because he sees many AI business models as engaging in common accounting illusions. He argues that the funding loop, where tech giants invest in smaller AI startups, which then use that cash to buy hardware or cloud services from those same tech giants, creates a false loop. It may look like a never-ending cycle on paper, but it eventually resembles structural fraud. Look deeper into how companies operate. The depreciation trap. Tech firms are purchasing advanced GPUs and depreciating them over 5 to 6 years to make their quarterly profits look better. However, since chip technology is advancing rapidly, the actual lifespan of these chips is only 2 to 3 years before they become obsolete. The insider exodus. The insiders are aware of this valuation disconnect. Data shows that NVIDIA insiders have sold off $5.4 billion in stock, Palantir insiders have cashed out about $7.2 billion. While the stock trades well below its historical highs, if the executives who create the silicon and write the software are hurriedly turning their equity into cash, why are retail investors buying in? They know the math doesn't add up. OpenAI is set to spend around $1.4 trillion over the next 8 years on data center infrastructure, while currently generating an annual revenue run rate of just $13 billion. That is a capital shortfall that no system can support forever. This leads us to the most important macro data point of the week, showing the bubble has completely inflated the physical supply chain, not just stock values. Let's examine Apple. The memory price. Shock. Over the past year, the relentless demand for high-bandwidth memory and advanced chips for AI data centers has pushed hardware prices sky high. It has become so extreme that Apple, the world's most powerful hardware buyer, can't absorb the increased US and allied chip prices without hurting its retail margins. In a surprising and desperate move, Apple is now lobbying the White House for permission to buy specialized memory chips from a blacklisted Chinese semiconductor company, the DeepSeek Echo. Consider the irony here. This is the same hardware shock that DeepSeek caused last year. DeepSeek changed the tech scene by proving you could train a powerful AI model for a fraction of the cost, wiping out $600 billion in NVIDIA's market value in one day. The ultimate confirmation. If the largest consumer hardware maker is working to bypass national security blacklists just to find cheaper Chinese components amid high AI-driven prices, that confirms the ecosystem is highly inflated. The entire supply chain is struggling under its own infrastructure costs. When the biggest buyer in the world states that your components are too pricey to produce consumer products, your pricing power is officially at its peak. Summary: the definitive macro verdict. Let's bring it all home to the clear structural conclusion about the AI superbubble. The noise. The AI boom is a smooth, endless growth curve, and any fund manager predicting a peak is merely an outdated contrarian missing out. The signal. The downstream revenue from AI software is failing to meet the enormous multi-billion-dollar spending on infrastructure. The capital flows are stalling. Corporate insiders are selling off at historic rates. And the hardware supply chain is nearing its breaking point. So, how should you manage your capital as this superbubble faces a volatile phase? First, carefully examine your portfolio for companies whose valuations depend solely on the continuation of this unsustainable spending race. If a business relies on a multi-year depreciation schedule for hardware that will become obsolete in 24 months, distance yourself from that trap immediately. Second, follow the smart money from insiders. When macro funds that predicted the 2007 crash are holding cash and tech executives are selling off billions in equity, the message is clear. Focus your investments on companies with organic cash flows, solid competitive advantages, and genuine cost savings. The hype-fueled growth is finished. The hard truths of economic reality are taking over. Understand the fundamentals, or risk getting trapped in liquidity. Stay vigilant, stay focused. That's it for this high-stakes macro edition of the Signal and Noise podcast. Make sure to hit that like and subscribe button right now so you don't get caught flat-footed when the market realigns. Protect your capital, track the insider tape, and we'll see you on the next block.